Welcome back to Revenue Margin, brought to you by Rob Molinek. Everyone's been asking me a question lately about, are we in another housing bubble? And should the U.S. economy be worried? Home prices are at an all-time near high. Mortgage rates are very elevated compared to the last 10 to 15 years. Affordability feels really broken for a lot of families. So let's separate the fear from the facts. The reality check is that today is very different from 2008. Back then, we had risky loans, over-leveraged homeowners, and massive overbuilding. Today, lending standards are really tight. Most homeowners have real equity. And we still have nationwide housing shortages. And really, that's a supply imbalance, though, and it continues to support these prices. The biggest risk today isn't a collapse, it's affordability. At 7% interest rates, the same home can cost thousands more per month than it did at 3% interest. And that really slows transactions. It freezes mobility of individuals wanting to change homes, and it really creates pressure, but not necessarily a crash. What policymakers are, looking at very closely is they're watching inflation, employment, housing stability. If rates stay higher for longer, you can expect flat or slightly declining prices in some markets, especially in the South, strength in supply-constrained regions, and really affordability improving only when rates eventually fall. And what's challenging is that where are you in that market, and where you're going to have the best benefit for you in moving forward. Overall, too, as I think private equity is changing the game. There's a huge shift that most people overlook and don't realize that private equity is now a major force in housing investment. Large firms like Blackstone and others have poured billions of dollars into single-family rentals and multifamily properties. What does this mean for you, though, is that they're setting a pricing power in many of these markets. They're long-term holders. They're not going to flip. And they're what they can buy, a lot of times individuals can't. That capital presence acts as a shock absorber, though, and it keeps the prices elevated right now versus having a reduction in price. How to prepare if a bubble does burst, though? Most people ignore preparation beats prediction. The smart households and investors prepare ultimately for the future. You keep 6 to 12 months of liquidity on hand. You avoid variable rate or over-leveraged debt. You stress test your budget for job losses or income swings. You don't speculate on investment, but buy only what cash flow supports. What I mean by that is that if you're going to have a loss on a monthly basis, you do not buy that property. You need to cash flow. End stop. And for business owners, secure financing before credit tightens. I truly think that credit rates are actually fair, and it's just that we were in a situation where very, very low rates occurred for almost a decade. I think we're back to more traditional rates today, and that there is a potential that rates could actually increase moving forward. Bottom line, should the U.S. be worried about a housing bubble? Not a 2028 stylish crash from my perspective, not due to bad lending. But I believe that there are potential region-specific affordability strain, regional corrections, economic slowdowns could be real risks. This is a pressure market, not a speculative mania like the 2008 crash. Ultimately, the winners in certain markets aren't the ones who are going to panic. They're the ones who prepare. If you want more insight on how to protect your wealth, your business, your balance sheet, and volatile markets, follow along for more. Love to hear comments below for those that are in the real estate market, or if you have questions, please add comment below. Once again, thank you also for attending another podcast of Revenue Margin, brought to you by Rob Molinek. See you in the next one.